system works. Done? Okay. And last we have something called as a gain sharing arrangement. Mark this. This will come in your exams. This will come in your exams. This will come in your exams. 5 to 6 marks. It will come in your exams. Chalo. Let's see what it is. Now, all of you have my books, right? All of you have my books. I have a publisher called as Make My Delivery. I have a publisher called as Make My Delivery. So what happens? What is the deal that I have with Make My Delivery? I'll just show that deal to you. See, this is the deal that we have. Make My Delivery publishes the books, say for rupees 500. Okay, he publishes it for me and then gives it to me at rupees 600. How much is Make My Delivery earning? Bolo, 100 rupees. And then this in turn I sell it for rupees 1000 to the students. How much am I earning? 400. So this is the thing we have. But he is able to give it to me at such low cost only if I promise him a certain number of quantity. So I have to promise him that at least 10,000 books have to be printed. Okay, and now I give the order to him. Okay, suppose I am a tax professor. Okay, I am a tax professor. I give him, okay, 10,000 units of books. I give you the order. Make 10,000 books. He will send it to me at 600 rupees. He sends all the orders. I have to pay him how much? 600 multiplied by 10,000. Are bolo? So 600, how much? 60 lakh rupees I give it to him. And tomorrow the finance minister comes and says that the tax rate is changed, the TDS system is changed, this is changed, that is changed with immediate effect. Can I say all of my books will become irrelevant? And it will say, she says that it will come from immediate effect, and ICAI also has to agree to it. So can I say all my books will become irrelevant? So there is a huge risk that I am taking. Correct or wrong? Now what happens? So this was happening in China. So Chinese people thought that let's have a different deal. MMD is into publishing, correct? MMD is into publishing. MMD says that, sir, let's have a equity deal. Let's have a equity deal. Okay, I asked them, what is the equity deal that you have? Tell me. They tell me that, sir, in order to make your book, it costs us 500 rupees. I said yes. Sir, effectively the book is sold in the market, say fees that you get for this is rupees 1000. I said yes. Sir, in all, can I say we are making 500 per book? I said yes. But there is always a tension in your mind that what if books are not sold? What if there is an amendment? What if there is a technological change due to which I will have to change the book? Colorful books are made now and some say graphics are added. What of these all things? Can I say all of this is now my burden? Because publisher is just acting like a manufacturer. I have given him order, he will send it to me, I will have to sell. Simple. Plus there is a tension to me that I have to sell them, so I have to do marketing also. All of this is happening, right? MMD, who is my supplier, comes to me with a equity deal and says, sir, 500 rupees that we are making, we will still continue with that, but please make me a partner in this deal. All the risks, marketing, everything that you are bearing will be borne by me, but make me a partner in profit sharing ratio 50% and 50%. Now instead of this 500 will now be divided between you and me at the rate 250, at the rate 250. How much was previously Make My Delivery earning from me? Make My Delivery was earning how much? 100. Now it is going to earn, can I say 1.5 times it is now going to earn more, almost double, yes or no? But at the same time it will increase its risk, production and all of that, it changes and everything. And what about Mr. Sankalp? How much was he earning? But now can I say he is earning how much? But can I say he's become risk free? He can focus only on his teaching, and all of this selling part and all of that will be taken care by Make My Delivery because he is the 50-50 owner. Plus, I as Sankalp used to give him 60 lakh rupees. Now I do not have to give him anything because he'll only produce and he'll only sell, no? He will just give me like a royalty 250 rupees per unit sold. Are we understanding? So can I say it's a win-win situation for Sankalp, for the supplier, make my delivery, and that's called, that deal is called as gain sharing arrangement. How much is the gain that we are making? 500 rupees. Can I say we are sharing that gain? But in turn, he is taking all my risks. I am now risk free. For that, I am giving a equity stake to him. Are we understanding? What is this called as? Everybody, what is this called as? Chalo, let's have a look. So GSA, gain sharing arrangement, is an approach to review an adjustment of an existing contract or series of a contract where adjustment provides benefits to both the parties. Does this adjustment provide benefit to both the parties? So first point of gain sharing arrangement is it is an arrangement which provides benefit to both the parties. Continuing. Fundamental form of GSA is where supplier performs its side of contract with no guarantee of receiving payment. Who is the supplier here? I am asking you, who is the supplier here? Suppose Make My Delivery publishes 10,000 books, and immediately the day he publishes 10,000 books, suppose it was the first scenario, if it is the first scenario, Make My Delivery publishes the book today, tomorrow the finance minister changes the law and I have to change the book again. Who is responsible to pay? Will Make My Delivery ask me for the money or not if it is the first scenario? If it is the first scenario, he'll ask or not? He'll ask, because I have to pay irrespective of whatever the finance minister does. Make My Delivery is not taking that risk. It is me who is taking that risk. It is me who is taking that risk. Are yes or no? Now let's take case 2. If 10,000 books are published and tomorrow the finance minister changes, amends the law, changes, ICAI says yes, new law will be applicable to all the students who are immediately appearing in the next attempt. Can I say all of those 10,000 books will have to be discarded? Who will be responsible for that? As in, will I, Sankalp, in this gain sharing arrangement now, second case is a gain sharing arrangement, no? In this, will I have to bear that cost or Make My Delivery? Are we understanding? So can I say Make My Delivery is taking a risk wherein he may walk away with nothing also, no? Or it can be otherwise also. Indian government says for the next 1 year, no amendment. So in that time, all my 10,000 units will be sold. So he may walk away with a fortune as well. For that risk only, he is being given that extra amount, right? Extra share, right? Are we understanding? Now connect my example to this line. Fundamental form of GSA is where a supplier performs its side. Who is the supplier in our example? Can I say he has performed his side by producing the books, right? To perform its side of the contract with no guarantee of receiving the payment. There can be a situation where he may not receive the payment, no, but there can be a situation where he may walk away with fortune as well. That's the risk that he is taking. Bolo. Okay. It is a win-win situation for both supplier and the customer. Risk in nature as a supplier can be rewarded with larger return or walk away with nothing. Are we giving him a larger return? For the risk that he is taking, are we giving him a higher return? Previously he was earning how much? 100. Now he is earning how much? 2.5 times extra is making here. But for that he is taking that risk also. Technological risk and amendment risk and all of that risk. Are we understanding? Okay. Equivalent to supplier taking an equity stake in customer. For MMD, who is the customer? Sankalp is the customer, no? Take the first scenario, Baba. When MMD was selling to me, who was the customer for MMD? Me. Now can I say that MMD has taken a stake only in me? And when you take the stake, you become a part of profit sharing, loss sharing. Are we clear, everybody? Are you now able to connect to each and every line that is written here? Because if the exam question comes, you have to write these lines. Will you be able to write these lines? Let's read it again. In this, what we are doing, just a moment. Yeah, in this, what we are doing, GSA is an approach to review an adjustment of an existing contract. What is the existing contract between me and Make My Delivery? That he will sell to me, I will pay him money. For that, he will charge a certain amount of profit that he has taken. I will sell to the ultimate consumer with a higher gross margin. Are we clear? So, Here now, can I say this existing contract is being reviewed? Bolo. So review of adjustment of an existing contract is happening. Review is happening and there is an adjustment of an existing contract or series of contracts where adjustment is now providing benefits to both the parties. MMD is getting monetary benefit. I am getting non-monetary benefit. Yes or no? Yes, now what is the deal? Let's read. First, fundamental form of GSA is where supplier MMD performs each side of the contract with no guarantee of receiving payment. Case 1, are we clear? Amendment immediately, finance minister, books change, clear. Second is win-win situation for both supplier and the customers, clear, because now even I am tension free, he is getting some money, so it's a win-win situation for both of us. Risk in nature, as supplier can be rewarded with large return if no amendment, all books are sold. If previously no amendment, all books were sold, he would have got how much? 10,000 books sold into 100 rupees. Now he is going to get 10,000 books into 250 rupees. Are we understanding, guys? Yes or no? So previously would have got 1 crore rupees. Now he is going to get 2.4 crore rupees, 2.5 crore rupees, right? Okay. So can be rewarded with large return from 1 crore to 2.5 crore or walk away with nothing if amendment happens. Equivalent to now, can we say that supplier has taken an equity charge? Can I say MMD has taken an equity charge in Sankalp? Are bolo? So can I say now we have a gain sharing arrangement between us? So equivalent to supplier taking an equity stake in customer. Are we clear, everybody? Yes or no? Tell me. Yes, sir. Okay. So example can be a cost saving initiative. So there is an example of a cost saving initiative at Chiang International Airport was done. Supplier will deliver 3% minimum cost saving on controllable portion. They had an arrangement. See, now different companies can have a different arrangement. Their arrangement was first year all the amount will be retained by the supplier. Second year it will be 40-60 ratio. Third year everything will be passed on to the Chiang International. So it's just an example. They can have any arrangement that they want. Any cost saving exclusively by Chiang idea does not be required to be shared with supplier. I will give you what was the example. See, Chiang International, have you heard? Have you heard Changi Airport? Changi name, so you feel China? No. Changi Airport is an airport of Singapore. World's best airport. World's best airport. I have been to so many airports of the world. Nothing beats Changi International. You will go when you become a chartered accountant for sure. Now, Changi International is a huge airport. Obviously, if it is the best, it has to be huge. And Singapore is a connector. If I want to go to, when I went to New Zealand, it was via Singapore. So from Mumbai I went to Singapore, then I went to Auckland. When I went to Australia, it was via Singapore. So any big place where I want to go from India, it is via Singapore that we usually go. So there are a lot of layovers which happen, there are a lot of flights that happen. It is also a financial hub of the world. So many Indian multinational companies have their office established in Singapore because it's very tax friendly. Flipkart is an Indian company, no? It has its head office at Singapore. So there are a lot of development which has happened in Singapore. So what Singapore said that we have such a huge amount of space available for airport. So airport is huge. For that we have to do its regular basis cleanliness and maintenance is to be done. Are bolo? Yes. Now they appoint a supplier who does the cleanliness and maintenance. That supplier said that, sir, outsource all of that to me. Let's have a gain sharing arrangement, and whatever savings that I am able to do in cleaning, maintaining the airport, pass on the benefit of that saving to me. Chiang International, it has to ensure that cleanliness and maintenance is proper. There is a gain sharing arrangement where previously that job was outsourced. So responsibility was of Chiang International. Now that responsibility of this supplier who is providing cleanliness and management services, they said that, but in doing that, whatever cost savings will happen, we will share it. In that, they said whatever cost saving was done by the supplier in the first year will be taken by him. Second year, it will be shared in the ratio of 40:60, and third year it will be passed on to the Chiang International. So it's a win-win situation. Now Chiang International is least concerned with all of the cleanliness and everything, or managing cost and everything, because there is a supplier who is doing all of that for them. Are we clear, everybody? So this is about your gain sharing arrangement. If a question comes, will we be able to write these 4-5 points which is there? Equivalent to supplier taking a equity stake in us. The supplier can run away with a fortune or nothing. He is taking a risk. Are we clear, everybody? So with this we complete the gain sharing arrangement, also called as cost saving arrangement, and with this we complete the second chapter.